Good afternoon. Welcome to September and welcome to Cup of Joe. I'm Mike Carrazzo, content manager here at Ryerson, and I'm joined by, like always, by Nick Webb.
Mike, how you doing?
Good. How's it going, Nick?
Doing really well. How about yourself?
Good. You look a little different this month. I want you to. You got a little scruff going on there.
You know, we're heading into cooler weather. We're this weekend. We're officially heading into the official college football weekend. And for the last 8 or 9 months, I've been spending time watching the carbon market, saying we're nearing the peak, and I've been wrong the entire time. So I figured, you know, as we get into the spirit of sports, the spirit of competitiveness, I'm going to do a beard strike. And what I'm going to do is I'm going to continue growing my beard until or unless we hit a peak in carbon prices. So we're going to look at carbon hot roll prices. We're going to try and determine whether that's going to be, you know, a month, 3 months, 6 months, as long as it takes. I'm going to keep growing the beard until we finally peak out and turn the other way. So I'm in this with our customers. I've been wrong for the last 7, 8 months. I'm going to put some skin in the game. But I think we might actually have a poll to include some of our customers on this one, right?
Yeah, and I gotta say, you know, I'm secretly hoping that it lasts a long time because I want to see like a ZZ Top beard going, because you got to commit to this. You got it on video, so you're committed as long as it goes. But you're right, we're gonna have a little bit of fun. Like always, we have the Q&A button at the bottom. Please send your questions. But this month you'll see something new down there. There's a poll button, and we're gonna try something fun here. Like Nick said, right? So how far from today will carbon prices peak? We have 4 choices there for you. Is it going to be 30 days, 60 days, 90 days, or 120 days? So go ahead, submit your answer, and we're going to try to tally up results, get some real-time polling going on here with Cup of Joe. Hopefully to get those results later on. But, you know, without further ado, like I said, you know, submit your questions in the bottom. We'll try to get to them as we go. If not, at the end, Nick always has time for his fans. But let's go right into it. Nick, I'm going to turn it over to you.
Yeah, I'll tell you what, if it's not the top answer of 30 days, I might have to submit my application for the next sequel, Team Wolf or something.
Yeah.
Hey. Could get a little unruly.
Not bad. Yeah. Worldwide.
But with that said, yeah, let's go ahead and get my screen shared so that we can hop into the presentation. Excellent. Mike, you able to see that one?
Yes.
Awesome. So first things first, we skipped over this last time, but this is the safe harbor provision. So this is not investment advice. For the sake of our legal team, we do not want you making trading decisions based just on what I'm saying. We are giving you the best of what we know, the best of what I know. May give some opinions of my own, but do your own research, grow your own beard, and make your own bets with friends about how long the steel market's going to last. Let's go ahead and hop into the macro side of things, because I think we got a lot to talk about this month. I think we're starting to see some very interesting deviations between what's going on within the macro side of things and the micro side of things. And when I say micro, I mean specifically with regards to some of the specific metals, some specific components within a lot of the supply chains. So first things first, we're looking a little bit differently at the data versus what we've done in months prior. We've in the last couple of months looked at the ISM, which is the Institute of Supply Management data. This is a slightly different source, but same general idea. And the reason why I've got this is because I wanted to pull in the EU data and I wanted to pull in the Chinese data. And this is coming from market, but it's generally doing the same thing. It's taking a survey of purchasing managers, trying to get a sense of whether or not we're seeing the economy from a manufacturing standpoint growing, staying the same, or contracting. And what I found interesting about this is, you know, I'm hearing a lot of analysts talking about, you know, have we hit peak everything? And I think it's a real potential theme, potential concern that I've got with regards to maybe the fact that, not that we're going to see things contract here in the United States, but certainly that we've seen things be about as good as they're going to get. Not to quote Frank Sinatra too much, but, you know, it is the best yet to come. In the case of PMIs, it maybe isn't. It might be behind us. And you can kind of see that in just the general arc of a lot of this data, whether we're looking at the US, the EU, or in the case of China. All of them generally have a similar trajectory, which is they are kind of rolling over since the last couple months. And obviously in the case of the EU and the US, we're looking at PMIs that are in excess of 55, 60, still very strong growth. So I do not want to be here to say the sky is falling, but I am going to say that I think there are some real potential headwinds that might be suggesting that the growth rates we've been seeing over the last couple months may potentially be a thing of the past in this cycle. We'll see. But I do think it is also similarly worth noting that China's PMIs are actually going into contraction territory. We'll talk about that in a little more detail here in a sec, but that is actually a bit of a, I would say, a yellow flag, because China does make up 50% of the world's manufacturing economy. And if they're heading into contraction territory, usually commodity prices do pay attention to that. And with that said, we have looked at this chart in the past. This is looking at the blue line, which is going to be the Chinese credit impulse data. We've talked about this for a number of months. China has been very actively trying to take away the punch bowl, take away risk-taking in things like the stock market, real estate market. They were trying to pop what they thought could be a bubble. And they've been doing that for a number of months. Why is that important? Why does that matter? Well, when you compare that to the Bloomberg Commodity Index, which is shown here in the orange line, generally speaking, there tends to be a relationship between how active or how accommodative the Chinese environment is relative to the price of commodities. And I think it generally makes sense. If they're propping up their economy, they're lowering interest rates, they're saying take all the risk you want, absolutely you'd think that commodity prices would go the same direction with a lag effect. The opposite can also be true. So for the last 11, 12 months, China's been trying to cool things down a little bit. We're finally starting to see the rollover in the Bloomberg Commodities Index. Now, worth noting, kind of similar to the PMI data, this is not sky is falling at this point. As we look at the right-hand axis, that is the axis where we're looking at the Bloomberg Commodity Index data. It's still suggesting growth in prices, but the pace of that growth is diminishing. So again, it's kind of similar to PMI, where we're not talking about contractions, we're not talking about prices collapsing yet. But if we continue to roll this forward a couple months, if we assume this correlation between credit impulse data and Bloomberg Commodity Index plays out, well, again, you look over the right-hand axis, we could eventually see that feed into true negative, month over month or year over year pricing with regards to commodities. So something to certainly keep an eye on. I think definitely with the fact that PMI data in the U.S. and Europe is also, it appears to be rolling over ever so slightly. I think it's certainly something that we want to keep an eye on as we roll into year end. And I think it's very important as all of our customers think about how to budget, how to forecast for next year. It may be the case that using the last 3 or 4 months may not be a great proxy to kind of straight line into next year. Maybe using something a little more reserved might make sense. Now, every customer, every industry is going to be slightly different, but there are a number of indicators that appear as though some of the best may be potentially behind us in terms of growth rates.
Hey, Nick, quick question. We've talked about that Chinese tightening the reins for the past few. Is there any indication how long that would go on? Like, is there, for lack of a better term, an end game there, right? To slow it X amount, or is it just tightening it with kind of no end?
Yeah, sure. I mean, I think to some degree they're trying to slow things for speculative reasons. I think to some degree they've been trying to, and may even continue trying to, slow things a little bit on the manufacturing side for, call it climate reasons, call it environmental reasons, or you can even more specifically say it's for the Olympics, because I do think that that's an element as well. So there is certainly a public message going out saying we want to reduce pollution. We particularly want to reduce pollution as we head into the winter season. And one of the reasons for that is because they want to make their skies look very clean for the Winter Olympics that are coming up in January and February. Is there an end to it though? Yeah, I think there are some analysts out there and economists out there who are now starting to say, well, I think China needs to be very careful about trying to cool their market too far, because they could start running into issues with defaults of big corporations and things like that. And that's certainly not something they want to do, or at least I don't think that's something they want to force have happen. So there is a chance that in the coming months we could see a reversion or a reignition of stimulus coming out of China, and then maybe taking interest rates lower, opening up lending markets a bit more. I think that's absolutely a potential. And I've actually got a slide on that here in 2 slides that we'll talk about that in a second.
I'm sorry, last dumb question, not last dumb question for the entire session, but last dumb question about these two. But does the first slide show that that is indeed actually doing what they're intending? Because if you look at the PMI, it's gone down, right? And are these two kind of correlated?
I would say so. Yeah. I mean, I would say there's definitely a correlation between the fact that we're seeing PMIs going into contraction territory and the fact that China has been contracting their lending standards. I would say there's absolutely a correlation between those two factors. So yeah, you can make an argument that some of that is purposeful. Now, do you want to tailspin your economy into a recession? Absolutely not. So it's a balancing act, but you definitely don't want too much froth. You definitely don't want too many defaults, things like that. Counteracting some of this, this is the Goldman Sachs the Goldman Sachs Financial Conditions Index. What this is looking at, and this is going all the way back to the inception of this index, what it does is it takes a smattering of indices across equity markets, so the US stock market. It's going to be looking at interest rates, it's going to be looking at credit spreads, and ultimately what we're seeing here is we're in a situation right now where we are seeing the easiest financial conditions basically since the 1970s. And I don't think it's any secret. We've got stock market at record highs. We've got 10-year yields at 1.2%. Money's basically free. We've just had how many trillions of dollars be printed and sent into the economy, to try and bridge the coronavirus lockdowns to now. I think most on the call would probably agree that there's a lot of money sloshing around the system. So when I talk about things cooling off, I think we have to counteract some of that with this idea that there's still a lot of money out in the system. Lending conditions are still very easy. Interest rates are low. Stock market's high. People are feeling pretty good. Now, there are some potential headwinds to that we'll talk about here in 2 slides. But before we do, this is again coming out of Goldman Sachs, and this is a new chart for us. But this is a chart showing what they call the fiscal impulse. And basically what that is a fancy way of saying how much government money is going into the system. And you can see that when you look at that, the vertical dotted line, that's basically where we are today. So over the last 12 to 18 months, no doubt about it, we've seen unprecedented, money coming out of the governmental systems, whether it's the US, Europe, or China. That money was meant to bridge the gap between, the locking down of the economies and getting people back on their feet to where we are today. We could have a lot of discussions about whether the appropriate amount was put in, whether too much was put in or not enough was put in, but you can see it just on a historical basis going over the last 15, 20 years, pretty staggeringly large amounts of money being put into the system. And what Goldman is ultimately quantifying here in this chart is what kind of tailwind or headwind did that money have with regards to GDP on a global basis. And you can see that it's had a very positive impact in their eyes on GDP, which ultimately means that manufacturing economy has been stronger as well. So has it been a little artificial? For sure. Some of it's been propped up by all of this money sloshing around. As we sit here today in Q3 of 2021, and we look forward to Q4 in 2022, the opposite is what's being forecasted by Goldman. And what's interesting is it's not coming from China. So you asked about whether or not China is going to flip the script. Their expectation is that, yes, that they're actually going to stimulate a little bit. And maybe that's for Chinese New Year, maybe that's for the Olympics. But for whatever reason, they believe that China is actually going to prop their economy up a little bit with some stimulus measures. But counteracting all of that to a large degree is the removal of a lot of these programs here within the United States. So their expectation, if you look at the gray line chart that's overlaying all of this, their expectation is that as we look forward from here, they're expecting a little bit of a GDP drag as we move beyond these stimulus factors on a net global basis. So would that be a headwind to the manufacturing sector? Absolutely it would if this plays out. So something to keep an eye on, because again, it could be a signal that the last 12 months have been a little artificial and a little propped up from government money. Another chart that we haven't discussed at length in prior months, but I think is one that's certainly worth talking about is how's the consumer doing? How's the consumer feeling? And again, this is just a survey, so this isn't hard data, this is survey data, but I think it's something we have to take into context. What we've got here is the consumer confidence data coming out of the Conference Board in the white line. And then we have the blue line, which is going to be the University of Michigan Consumer Sentiment Index. And what first caught my eye was the fact that the Consumer Sentiment Index is actually at its worst levels in 5 years, even worse than at any point in 2020. So does that make sense? Does that make sense that the consumer would be feeling worse now than they would have been at any point last year? And I think it's pretty perplexing. A lot of the blame from economists and analysts that I've seen has been that a lot of this rollover in both of these indices has been tied to the Delta variant and the reignition of restrictions. And I think that's part of it. I think it's also worth noting, though, that the Delta restrictions really just kind of started in the last 30 to 45 days. A lot of these turnovers in the consumer confidence data and the consumer sentiment data actually started all the way back in May, June of this year. So there may be something else going on, that perhaps there's a situation of, well, maybe inflation is starting to rear its ugly head a little bit. Maybe there's a little bit of, well, some of these stimulus programs are coming to an end, and the consumer's just starting to, tighten their budget a little bit more, perhaps. I think when we specifically look at the consumer sentiment data, that survey is a little bit more tied to household goods. And I think when we peel the onion back a little bit and we think about, well, why would that be such a difficult thing? We look at house prices right now. Home prices on a year-over-year basis are up 19% year-over-year. The price of cars is probably up 20 to 30%, if you even can get one. Appliances are up. Inflation generally is quite strong right now. So I think from a consumer standpoint, there are some real concerns that the consumer is getting bit by not just the COVID lockdowns, COVID fears, but also by inflation and by potentially a little bit of a rolling over maybe in the business cycle. That maybe we ran the economy a little too hot. We've got to come back down to earth, and the consumer's starting to get a little more cautious. We'll see. I think subsequent months we'll see if the Delta variant is the primary rationale or the primary reason for this rollover. But I think this has gotten me a little spooked, ever so slightly. And then feeding into that, when we talk about the sentiment data and how's the consumer feeling, the ability to get a car right now is extremely difficult. And what we're looking at here is auto sales data. We're heading into pretty ugly territory again since basically April of this year. Back in April, we were running in the United States at an automotive run rate of 18.5 million units. We're all the way down at 13 again. That's a big move off the highs. It's a big move off the pre-COVID, I would say, average. And this is a topic that we've discussed in months prior, and we tend to always get questions about this. Is automotive eventually going to feed through to a weaker steel market? And the answer up to this point has been not really, because the automotive sector seemed to have been taking the steel still, putting it into work in process inventory. So they were still consuming it. They just weren't pushing the cars out the door. I still think for the most part that is true. And we as Ryerson don't seem to be hearing many rumors about steel that was earmarked for automotive coming out into the marketplace and becoming available. We're not hearing large instances of that. But the longer this plays out, the higher that risk becomes. And particularly as we head into 2022, if those automotive contracts reset from a really advantageous level to something closer to market, there's a chance that the automotive industries might start to say, maybe we shouldn't buy as much steel anymore because we've got an entire speedway, motor speedway full of work in process inventory. At some point, we've got to imagine that steel demand will be impacted by the fact that auto sales are getting hit so hard.
Nick, I know this might be a crystal ball for you, but I mean, there's got to be something with the working from home over the past, call it 2 years, going on 2 years, right? I mean, people have rethinking a lot of ways. Could be not using the car as much, but I don't know. I mean, I guess with any of these, like University of Michigan or any of these indices you're tracking, do they take that into account, how maybe this work from home has maybe changed some
Absolutely.
of the consumables and things like that?
Yeah, and that's why I wanted to note the fact that this is soft data, not hard data. And what I mean by that is it's a survey, because it is, how are you feeling? I mean, it is a little soft and fluffy, if you will. And I will readily admit that there's a chance that the consumer just isn't feeling as great because we've been in this situation now for 18 months, that maybe there's just a little bit of lethargy at this point. So yeah, there is something to that some of that could be spilling into negativity with regards to the consumer. But I would counter that by saying if the consumer is feeling negative for any reason, that may impact spending habits.
Or the fact they just might rethink some of their normal route, right? Don't need a second car, don't need this, don't need that. Time will tell, and I'm not asking you to put on your
no, and I would say right now,
plan.
if we use if we use the stock market as a proxy, you look at GM, Ford, some of the big automotive stocks, they aren't tanking the way this chart is indicating they could. And I think a lot of that is predicated on this belief that, okay, we get the fact that automotive sales are bad, but we're going to blame the bad automotive sales on the semiconductors, because at some point, semiconductors will become available, all these other components will become available, and the consumer will be there. That's why I think the equity market is kind of looking through to the future and saying, eventually this is going to sort itself out. We just don't know if it's going to be 3 months, 6 months, 9 months. I think the more we roll through time, we get color from sort of what's happening outside of America, the more I personally get a little concerned about that. And I will say that, to your point, if the consumer ends up saying, okay, this has lasted too long, I'm going to the sidelines, I'm not buying a car anymore, then I would become very concerned, because at that point, not only would you see, all the cars being finished, you would probably see auto prices come down, and then you'd see an overabundance of supply because consumers have decided they don't want that car anymore. That's not my base case. That's not where I land just yet, but it's certainly a risk. I think it's relatively low at this point.
Sorry for parking us here, no pun intended, but somebody else has brought up, one of our audience members, Toyota's cutting global production by 40% due to the ongoing semiconductor shortage, as you stated, right? If other automakers start to follow suit, could that have any near-term impact on supply and then pricing? Is the question.
Yeah, I mean, it's definitely the question that we've gotten consistently in prior months, and the answer for now still remains the same, which is most of automotive continues to take that steel. But if this continues to play out into 2022, and in my opinion, if the steel mills then go to those automotive companies and they say, hey, surprise, your new contract is up 300% from a pricing standpoint versus the prior year, I would think the automotive sector would probably look at that and say, well, we should probably start buying a little less steel. Because right now, I would argue that part of the reason why automotive is buying all the steel that they are is because, one, they've got take or pay agreements, perhaps, and two, their pricing is so advantageous relative to the market that they're happy taking it, because they know that if push came to shove, they can just sell that steel off to somebody else or whatever. It's very, very advantageous. If that steel becomes less advantageous, that incentive to take extra metal becomes less. So to answer the question in a sort of nuanced way is, I think for the next couple months, it doesn't matter as much as we think it would, but as we roll through time, it's definitely something that we want to keep an eye on, because automotive is a huge consumer of carbon flat roll. And if global automakers start to say, no more, no mas, we don't want all this steel, we'll see supplies react very, very quickly. We would probably see prices react very, very quickly in that environment. But with that said, we talked all about the macro side of things the last several slides. The micro side of things, or more specifically, when we drill into the metals themselves, are still pricing right up near 5-year highs. So this is the Industrial Metals Index by Bloomberg. So this is going to be copper, aluminum, zinc, tin, lead, and you can see we're right at the 5-year highs. We've tested this level a couple times, bumped into it, kind of failed, but we're definitely at elevated levels, despite the fact that I think that some of the macro indicators are showing a little bit of softness and squishiness. One of the reasons why I think that is, and as we think about semiconductors and we think about foreign components and foreign parts, this is, I think, a really good proxy for what that landscape looks like, which unfortunately is not getting any better, in my opinion. This is a containerized freight index for getting a 40-foot container to move product around the world. And you can see the chart's just gone parabolic. It's continuing to go parabolic. And we're in an environment still to this day, which is right, wrong, or indifferent. We're in a situation where Australia, New Zealand, Indonesia, China, Singapore, Japan, and a few others in the East, the East Asian economy are taking the approach that if they get a small outbreak or maybe even a single case, they're treating that as a lockdown. It warrants a lockdown. And just a couple of weeks ago, I think it was 3 weeks ago, the second or third biggest port in the world locked down because of a single case in China. And why does that matter? Well, ultimately, they're shipping semiconductors, they're shipping valves, components, maybe finished products, machine parts, all the way to the United States. We try and think about when these semiconductor issues are going to end for automotive, or when these subcomponent issues are going to end for other manufacturing supply chains. Unfortunately, if we continue to see this stance that a single case or a couple cases, and again, I'm not here to say what's right or wrong in terms of approaching COVID, but if that is the approach, I think that we're going to see many more months of these types of issues on the foreign landscape. I personally think domestically, we're actually seeing things improve quite a bit, whether that's vaccination rates improving, whether that's more just people getting more comfortable with moving around, general mobility data improving. I do think that US markets logistically are opening up a bit. And I also think supply chains, particularly in steel and aluminum, are actually catching up a bit. I think there's some optimism there with regards to that getting better. On some of the foreign markets, it may be getting worse. And we can talk about this in more detail either at the end or as we talk about each of the metals. But I don't think metal, even though metals charts all look parabolic and they look crazy, I don't think metals are the primary concern for, at least not commoditized metals, are the main concern for a lot of our customers. And I'd love to hear feedback on that. But based on some of the conversations I've been having, there are a lot of other components and labor issues that are probably more heavily risking the shutdown of manufacturing facilities than metal would be, which is crazy to say because we've seen some wild environments already within the metals scene.
Hey, Nick, there's a question from the audience. I haven't heard this one before, but have you heard of offshore material being held, quote unquote, for ransom? In other words, shipments confirmed months ago now requiring additional funds to release the shipment. I don't know if you've heard anything about that.
I don't want to say that it's a conspiracy. I also don't want to say that that's not true. I will. How do I want to say this? I do think we are seeing past dues, both from domestic suppliers as well as foreign suppliers that are very extended. Even here within North America and steel supply chains, we have and do see past due orders that are 7-8 months long. Is that a producer holding somebody ransom? I'm going to be a little more optimistic than that, but could the semiconductor issue be a little bit of gamesmanship? Could there be some holding of hostage to try and show prowess on supply chains? It's absolutely a possibility. And yeah, whether you're talking about pharmaceutical products or rare earth metals or semiconductors, yeah, those are all very geopolitically sensitive items. And I would say they would be leverage items for a nation if they wanted to utilize them in that way. I don't want to speculate on whether or not they're holding them ransom, but I do think there are backlogs for sure of many months. With that said, let's go ahead and hop into each of the metals, and we'll move a little quicker through these, just because I think a lot of these charts are going to be pretty familiar. But carbon has me a bit befuddled, and that's one of the reasons why I wanted to throw some skin in the game with my beard, because almost every component we look at with regards to drivers we would have historically looked at to determine steel prices are all going one direction, and that direction is not up. Whether we look at scrap prices are down about $20 per metric ton on a month-over-month basis. They're actually going the opposite way from steel. Iron ore prices are down 35% in the last 3 months. As you can see here in this chart, European prices are turning lower. Chinese prices are even lower on a month-over-month basis. The only one that's really green in my book is capacity utilization. And depending on what camp you're in, you could even make the argument that capacity utilization returning back up to 85%. maybe is even a bearish signal. But all those other ones on the raw material side and looking at foreign markets, they're all headed to the downside, yet US steel prices are still going up, at least for now. I will note, and I do actually think it's worth noting that this week the CRU printed higher by $6 per short ton, only $6, taking the price up to $1,918 all in per short ton. Is that a sign the momentum is beginning to dissipate a little bit? It could be. I would say that if we use the raw ingredient side of things, scrap iron ore, some of those elements, it would be indicative that we could see things turning over or flattening out. We will see. I mean, I've been quite wrong. A number of analysts have been quite wrong in terms of the trajectory of how high we would go, but there are a number of indicators that we've historically used to guide us on these markets that are pointing lower at the moment. We've talked about this in the past, not a whole lot of change on a month-over-month basis, but at this point, we've got capacity utilization up at 85%. It's really kind of hard to imagine US production utilization goes much higher than that. 85% is a pretty darn high number. And you can see that as we look back over the 5-year history. We're already in excess on a percentage basis to where we would have been pre-COVID. On an absolute tonnage basis, we're essentially in line with where we would have been pre-COVID. If in the event we start to sprinkle in this idea that maybe automotive shutdowns spill into a little bit of a demand slowdown, that would obviously allow mills to catch up quite a bit. I think we talked about this in the last month's Cup of Joe. But for the first time in a long time, when we look at MSCI data, we have for the first time seen shipments decline slightly and inventories grow slightly. And that's true both within the carbon landscape and within the aluminum landscape. And whether that's seasonal or whether that's something that's becoming a new trend, it doesn't really matter in my eyes if we think about it in the sense of supply is catching up. And whether or not it's seasonal, supply is catching up. And you can see that just by looking at the months of supply within service centers ticking ever so slightly higher. That's really kind of the first indication that service centers are becoming to be, a little better stocked. I think material is less hard to come by. It's just expensive now. So we're evolving from this landscape where for the last 6 to 9 months, maybe 12 months, we couldn't find new material in a lot of cases. We're kind of evolving into this situation, particularly in carbon and aluminum, where we can find it in most situations. It's just, if you want it, you got to pay up for it. So it is an evolving landscape within the supply chain, but I think tons are becoming available both in carbon and aluminum.
Nick, this is a good time to pause. I don't mean to stop your momentum here, but as we go along, I see other folks join. So I just wanted to point out in the bottom, we have a poll this month based on what we're talking about right here. The question is, how far from today will carbon prices peak? We have 4 options there. Nick alluded to with the beard, where he's grown it out until they peak. We want your answer. We'll tally those up and get the answer at the end. So I just wanted to mention that for those who jump in.
Will Nick look like a homeless person, a gorilla, or a werewolf by the end of this?
Yes.
And this chart might very well make me look like a werewolf. We'll see, because this has really been the trajectory of the futures market for the last 8 or 9 months, which has been in the very near future. The market is currently expecting that prices are going to roll over. It continues to move onward and upward, up and to the right. But there is still this expectation that the prices are going to come off in the very near future. It's been wrong every single month for 2021 thus far. So will we see futures markets being accurate, or is the beard just going to continue on into eternity? We will see. But what's worth noting is this is a new one, or a new theme that had not been the case in months prior, which is scrap prices. In other words, one of the main raw ingredients to make steel is actually dropping in price. So I'm not trying to say the steel mills are bad guys or good guys or whatever, but the margins at the steel mill are certainly widening because scrap prices are coming down. Steel prices are still on the rise. But I think this is certainly something we want to be cognizant of, because there are a lot of electric arc furnaces that are coming online, and there's been a lot of speculation, and there was as well at Steel Market Update last week that when I say we, the United States is going to run into a shortage scrap situation. Well, I would actually counter that by saying if we were going to run into a shortage of scrap, we certainly wouldn't see scrap prices at $600. I would argue we'd see scrap prices at $1,500 to $1,600 because that would be where they would think they could charge. If it was name your own price within the scrap mill and scrap markets were actually sufficiently tight, then the scrap yards would be in the driver's seat. The fact that scrap prices actually declined on a month-over-month basis tells me that either on a global basis or specifically on a US basis, there is enough scrap out there, is what it tells me. So flipping over to aluminum, we talked about the left item last month, which was Russia implemented an export tax, all in an effort to really kind of stymie inflation within their own domestic economy. That is now in effect. We have seen that play a bullish role, not just within Midwest premiums, which are now sitting around 34, 35 cents. We've also seen it play in a bullish fashion to London Metal Exchange prices, which I don't think many analysts really thought that it should have had an impact on LME, but it looks like it kind of has a little bit. But in the last couple of days, we've gotten the addition of what's on the right-hand side, and I apologize, this is not a reading exercise, but ultimately China announced, again, for environmental reasons or climate reasons, that they wanted to cut aluminum production. Now, there's a chance you can make the argument that maybe China's cutting aluminum production just because they see demand weakening. That's a rational argument as well. But whatever the reason, China's cutting aluminum production. That announcement alone, because China represents 60% of the world's production, did put a bid into aluminum prices. So on Monday, we literally saw the price of LME aluminum jump by about 3.5 cents, which is a pretty big intraday move. Now, with that said, LME prices hit kind of, I would say, a technical high level. So this is looking at a 5-year chart of the LME price. And this is actually looking at an intraday chart. And the reason why I pulled an intraday chart is because the last time we got to this price range was back, many of you may remember this, but this was the day in which the United States put in place sanctions on Rusal, which is the second largest aluminum producer, and a number of oligarchs within Russia. And almost instantaneously, the price of aluminum jumped like 25, 30 cents. And it didn't last for long because eventually those sanctions were lifted and we found a middle ground. But I do think it's worth noting that we have hit that intraday high. If we look back at a 10-year chart or a 15-year chart, there is another time period back around 2011 where we similarly got around this price range. Why I bring that up is because, one, from a technical standpoint, there are some who would say, well, that might act as resistance to price because that's sort of where prices go to. Then they tend to hit some resistance. You see a lot of selling, profit taking, things like that. I'm not here to say that that's for sure what's going to happen, but there was a note put out earlier this week by Harbor, who is kind of raising the bell saying, we think we're in the peak of the cycle. Prices have hit, decade high type pricing. They're starting to think there's going to be profit taking in the future. I don't know whether that's going to be the case. I just wanted to make sure that I mentioned that because they are kind of ringing the alarm bell saying prices run too far, too fast. We're going to start to see some profit taking. It is worth noting Harbor's got their aluminum conference next week. I'm sure we'll see a lot of headlines coming out of them and out of Chicago next week when that conference takes place. And I look forward to hearing what kind of dialogue comes out of there. It was mentioned earlier this morning that with regards to the Russian export tax, a Russian authority, I think he's in charge of like their mineral committee, if you will. He basically said, we don't anticipate the export tax extending anywhere beyond 2021. So the expectation is this is going to be a fairly short-lived export tax. Beyond that, markets should start to loosen up again. Similarly, the Chinese announcement of production cuts is expected to basically go up until January, February, which would get you right up until the Olympics, get you right up until the Chinese New Year. For both of those reasons, the futures market for Midwest premiums are still downward sloping. So even though we see spot Midwest premiums right around 34 and a half cents, there is a heavy downward slope in the futures market. And actually, when we look at this chart on a month-over-month basis, the futures curve has actually moved even steeper into a downward slope, which indicates that come 2022, the expectation is that premiums are going to start to normalize. I don't know if exactly the same thing can be true about LME, that there's an expectation that LME would also normalize to the downside, but certainly on the premiums, we can see that just as we look here at the futures market. And then lastly, on the nickel side, nickel's been incredibly choppy, as you can see in this chart. There isn't a whole lot to glean from it from a technical standpoint. From a fundamental standpoint, I would say we still are in a situation where $9 seems to be acting as resistance. And again, I guess that's a little more technical, but from a fundamental standpoint, the market's well supplied with nickel units. I think nickel has mostly been trading in line with the broader metals complex. So as we start to see inflation, nickel tends to get a bid, but thus far, $9 has acted as a ceiling for that market. I did mention the fact that aluminum and carbon markets are starting to see a little bit of supply availability. I will say that stainless is a bit of an exception to that rule. And I think this chart is one of the reasons why, because this is looking at appliance shipments, and this is coming out of the durable goods data. Pretty staggering chart when you really take a step back and consider what's going on. Mike, you had mentioned sort of what's the consumer been doing during lockdown environment. One thing I can tell you they have been doing is buying appliances. I think a lot of people, both in the United States and around the world, were kind of sitting in their homes locked down, looking at their kitchen and saying, boy, this place is not very, very exciting. We need to get a new stainless steel appliance. And that appears to be what happened. So because of this, I think there are massive backlogs of orders, both within the individual consumer as well as within the commercial landscape, that there's been a huge ramp up, and you can see it. That type of growth rate is not normal. It is pretty unprecedented, and this is going all the way back to 1990. So the stainless steel mills have to get caught up. Now, being the life of the party and the cynic that I am, I do want to bring up the other side of this potential story, which is if we think about spending habits on appliances and things like that, I will say the unfortunate side of this market is, at least based on my spending habits, if I'm going out and buying all new appliances and I renovate my kitchen, I'm probably not going to renovate my kitchen again the following year. So I do have a little bit of a concern that once stainless mills do get caught up, that there will be some sort of hangover effect on this, that once everybody's renovated their kitchen and tossed it on HDTV, there could be a glut or a hangover effect where nobody wants to buy appliances for a couple of years. I don't know exactly what that looks like. I'm just kind of hypothesizing and trying to look through what the other side looks like. But for now, it is definitely a catch-up game. Lead times are still long. Stainless is bucking the trend of what we're seeing on the supply side and availability within the other two markets.
That's a really large run up there. That's really eye-opening. I could say, we were in that boat too. I mean, new appliances last year. I think it's just, you're right. I mean, I think people were kind of, they're being in the house now, so they want to redo things. But you're right. I mean, what is that going to mean come a year from now? Interesting chart. Yeah.
Next month's cup of Joe is going to be from your kitchen. Your brand new.
Yeah, exactly.
And then lastly, relatively muted, but it is worth noting that molybdenum prices, which saw that parabolic run up in the April-May time period, just on supply tightness, it hasn't yet corrected back down. So it continues to move mostly sideways. Again, for 316 prices, that's going to mean more elevated 316 prices, but we'll breeze right through that. So with that, happy to open it up to Q&A.
Thank you, Nick. A reminder, if you have any questions down there in the Q&A portion, please send those along. We have some time here to get a few more in. Let's go back to the capacity utilization chart, if you will, Nick.
Sure.
Question is, 85% of capacity utilization is based out of what mills are open currently. Is it either based on what mills are open or based on the total production capacity, regardless of the mill? So I think that's a question about the total capacity, or if they're open or not.
Sure, that was a mouthful of a question, but I'll do my attempt to paraphrase. So the question is essentially, what is the math behind the capacity utilization percentage? And the idea is each of these mills has a nameplate capacity that they say they can produce. Now, sometimes when markets are really, really hot, it is possible that they can theoretically go beyond those nameplate production capacities. But what this index does, or what the percentage does, is saying, based on what they say they can produce, based on nameplate production, what percentage within America is producing. So I hope that kind of answers it. So if something curtails for a period of time, that would bring the percentage down, because that asset could be producing during that time. You may notice, this question wasn't asked, but you may notice that there is a spread that occurs between the percentage and the absolute tonnage. And what happened there was, because there have been so many closures, and because there have been, I'm going to pull this down real quick, because there have been so many closures and so many mothballing and idlings of mills in the last 18 months, the AISI, which is the group that actually puts this index together, they basically said, we need to have another look at this index and the way that we compile it, because the assets that are producing now is a lot different than what would have been producing 2-3 years ago. And for that reason, that rejiggering of the math is what caused that spread to occur.
Makes sense. Yep. Very simply, I have a question about two acronyms you've used: RSPR. The other one is RSCURSTE.
Yeah, so
never call the last one.
Yeah, I hate acronyms, and I apologize that they're even on this slide. But the RS curate is going to be that's the capacity utilization percentage. It's the index that's utilized within Bloomberg. So that's basically the ticker symbol. RSPR is going to be the tonnage in thousands that's being produced. So in this case, 1.873 million tons in the week, in the last week.
Okay, great. A lot of questions coming around specific slides. So now if we can dial back to the scrap slide.
I hope so.
The question was quite simply looking at Q1 scrap prices. Can we kind of hone in on those? Like, do we know what the price comparison Q1 to now?
Yeah, I mean, so one thing I will say about the scrap futures market is, full disclosure, this is not a market that trades really heavily. In fact, it doesn't. We've never traded this contract at Ryerson before. So we do a lot of derivatives trading and futures trading. We've never traded the scrap contract. It's not to say that we're not open to it, but the reason why I bring that up is because there are prices in the futures market for scrap steel, but they don't move around all that much. So when they do move, I think it's worth making note of. But with that being said, I would say, generally speaking, the curve is pretty flat looking out to June of next year. You know, plus or minus a couple dollars, it's $600 or $620 per metric ton. Was there any follow-up with regards to?
No, just looking at a price comparison. I think when you start to look at these charts, right, the numbers kind of bunch together here. But I think if we can zero in on those, I think that's what I was getting at. That's good.
Just to expand slightly on my comments around scrap. You know, if you were wound to 2007, 2008, which is the last time we saw steel prices get to record highs, steel prices HRC went to about $1,100 a short ton. When that happened, scrap prices, busheling scrap, would have been right around 800 to 850. And what I find interesting about that is, despite the fact that steel was $700, $800 lower than where we are today, scrap was actually $200 higher. And what's interesting is the scrap to steel ratio or relationship of roughly $200 to $300 maintained back in 2007, 2008. What's interesting this time around, or I find it very interesting, is that spread relationship doesn't exist anymore. It does not exist in this current environment. And I don't have a great explanation as to why, unless we acknowledge the idea that there's plenty of scrap out in the world right now. Because otherwise, I think I mentioned this, if I'm an independent scrap yard and I've got a bunch of carbon scrap sitting in my yard, and a steel mill is coming to me saying, I want some of your scrap, I'm looking at where the steel price is, and I'm probably saying, I'm not selling it to you unless you'll pay $1,500, because I know what kind of margins you want to make. The fact that they're not able to sell it for $1,500 tells me something, I think.
Exactly. Agree. back to the container slide now. This is actually kind of combining two questions. Last month we compared the container against the freight market a little bit. Curious how the freight market's doing, and then there's a specific question around air freight costs. Do we know anything what air freight costs are doing compared to these container costs?
So I did have a look at the U.S. freight index, which the freight index I referenced last month, and I compared it to the Bloomberg Commodities Index, was the flatbed rate. And I did have a look at it. It didn't have massive moves, but I will say the general rolling over and slight softening has continued. And I think that corroborates with this general theme that I've said, which is I do think the US markets are loosening up a little bit. So I think that is in line with where flatbed rates are, which have come down a little bit. The second question, air freight markets. I unfortunately don't have that answer. I can try and have that answer as a follow-up and reach out. I haven't looked at air freight ever, to be honest.
New chart for you next month, air freight.
Yeah, I'm not sure Ryerson's shipping around a whole lot of coils of steel in airplanes just yet.
Yeah.
But maybe that's a new business proposition for
us. Yeah. Another one on the capacity utilization front. Have you heard much about delays from NAS in November, the mill outages?
I will say that allocations are very much just still a thing on the stainless side of things. I don't have a whole lot more in depth with regards to it than that, but the stainless markets are incredibly tight. I mean, all the things we've seen with regards to tight markets and consolidation on the supply side are even more so true within stainless, because really within North America, we've only got two players, North American Stainless and Patakampu. So yeah, no, there's definitely shortages. In terms of outages, I would have to check back on that one.
Yeah, I guess, our planned closures starting, and they're going to continue through the end of the year. I mean, that's always something you deal with regardless of market conditions, right?
Is that asking in terms of end customers or suppliers?
Yeah, it says planned closures started in August. Did these happen, and when will they continue through the end of the year and keep prices inflated?
Yeah, I mean, I think in terms of the production side, yeah, there are definitely going to be curtailments. Many of them have already been announced. Some of them are 7 to 10 days, things like that. And then that's true across all markets. I will kind of go one step further on that and say I actually do think there are risks of plant closures on the consumer side too, though. I don't think we've spent a whole lot of time talking about that, but I do think there's a real risk that if some of these semiconductor issues, component issues continue to be a theme, I think there are real concerns at the end demand level that they might end up kind of breaking some of the supply chains, and you might actually see manufacturing facilities stocking out and having to stop production. I don't necessarily want to put a high risk on that, but I think it's a risk. So it can happen on both the supply side and the demand side, I guess is my only point.
Absolutely. Well, we're running out of time here, but are we able? Has everyone seen? I know we put up the answers to the poll here. I'm gonna cry ignorance here. Do we all see this, or is it just me seeing the results? Do you see these, Nick?
I pulled mine up as well, just in case you need to see my screen. So it looks like the vast majority. Well, it's not really the vast majority. It's about a third of people are indicating 60 days. So half of the participants are within 60 days. But we have another 48% that's thinking this is going to last 90 to 120 days, which better throw away my razor.
Yeah, that's 120 days. If you look at it, it's all kind of fairly even. I mean, all things considered, right? I mean, you got the 60 days, but yeah, I'm most for your beard growing. I'm rooting for the 120, but none. So I just kind of want to see how that plays out. But yeah, those are some good results. So thanks everyone for participating in that. And I think that's going to conclude. We have a few other questions here that I believe would go elsewhere. So we'll follow up with the appropriate person within Ryerson to get answers to those questions. But Nick, any closing thoughts? A lot of information. I like a lot of new macro data this month. Very interesting things here. But we're starting to head into the latter part of the year here, right? Final quarter. What is your what are your words of wisdom?
Yeah, a couple things. I mean, one that's really kind of fresh, and it's so fresh I don't even know how it plays out yet. But I did kind of skip over this. It is worth noting that in the last couple hours, Secretary Manchin, who's kind of one of the swing voters on a lot of the spending bills, the infrastructure bill and the $3.5 trillion bill, he did hit a headline just a couple hours ago saying he thinks the Senate should pause the $3.5 trillion spending bill. I just wanted to make sure that was noted, because we have historically gotten questions about what does the infrastructure package look like? What do the spending bills do for steel demand? And I always kind of give the answer of, I mean, I'll tell you once it's passed, because it's amazing how bad our political system is. That's maybe neither here nor there. I probably shouldn't even mention that, but it's amazing how slow and how convoluted and how these things evolve. But anyways, takeaways for all of our customers. As we sit here at beginning of September, we're pretty thick into the discussions and thinking about 2022 at this point in time. I would say stay very close to your sales reps, stay very close to our supply chain teams. Obviously, the contractual negotiations are probably going to be very different this time around than they would have been a year ago, because I mean, from a pricing and availability standpoint, we're just in a whole new world. In some ways that may be good news, some ways may be bad news, but we look forward to working with you. If there are ways that we can help make sure that you're not stocking out of material, we want to be there. And if there are ways that we can help manage price risk or inventory risk, we want to be there as well. So keep us in mind, and I look forward to hopefully seeing many of you in person here in the not too distant future. But stay close with your Ryerson sales reps, and hope you have a great month of September.
And a few closing thoughts from my end. Thank you, Nick. As always, this full recording will be on YouTube starting tomorrow. Then we do break this up into shorter snippets. Key pieces, if you want to go through the highlights, those should be up on ryerson.com, the gauge, by the end of next week. And of course, just want to qualify my earlier statement. The only reason I want 120 days, not because I want prices to go higher, I want to see Nick's beer. That's the only reason. So
yeah, I mean, if it goes 120 days, my entire window is just going to be a big giant red Irish beer.
Thank you, everyone, and we will see you in October.
Awesome.